हमारे गुजराती में एक कहावत है, दुकारमा अधिक मास. When there is famine, there is also an additional month. So instead of 4 months, you have to bear famine for 5 months. And Major साहब, हमारी मार्केट में ऐसा ही हो गया. In rupee, RBI was shot forward by $60-70 billion. And then, oil prices went up. In interest rate, RBI was about to end their monetary policy rate cut cycle. And now, because of inflation and rupee, who knows what they will do. Equity market FPIs were selling aggressively. And now with this vulnerability, they have started selling even more. So, first, Neelkanth bhai, to you, how do you decipher rupee rate and equity?
Okay, so let's start with the currency. So I don't know if you've been tracking, but last Friday, the RBI passed a very dramatic change in policy. So they limited arbitrage exposures to $100 million. A very inane type of press release that came out. A very, very harmless, not inane, but harmless press release that came out. Frankly, even I thought that this would mean a $5-6 billion adjustment, and what the RBI was trying to do was fight the battle on its own turf. So basically, to simplify, there is an onshore market, which is within India, where the RBI has authorized dealers, deals with all the dollar income and outgo. And there is an offshore non-deliverable forwards market. Basically, that you can trade the rupee, you don't need to take the rupee. So what you say is that you come in at 92 and you think that it's going to 94. When it goes to 94, you just book the 2 rupees, right? So it's a non-deliverable forward. Now, what I was shocked by was that the arbitrage positions were $40 billion, and there was a further $30 billion of options. This suddenly made so much sense because our balance of payment deficit, basically how many dollars you need versus how many dollars you are getting, that gap between that, the deficit was only $15-20 billion. But the RBI had burnt $40-50 billion, and it was like a bottomless pit. And then in March, we heard that RBI is intervening heavily, $25-30 billion, and the rupee is not stabilizing. So what was happening was that in 21, when this arbitrage was allowed, the RBI was trying to internationalize the rupee. So that, because it was a protected market, they said, look, let the NDF market and the onshore market be connected. And now they realized that this is becoming like a leaky bucket. So you keep intervening, but someone outside, some macro punter is saying, you know what, RBI is already short on the forward side. We don't know how long the oil prices will remain high. And so in this uncertainty, I can keep hitting the rupee. So in one shot, the RBI was able to close it. Now, of course, that also means that banks had to book heavy losses. They're extremely upset. And the internationalization of the rupee is now been set back by many years. But what it does do is then now the RBI can fight the battle on people who really need dollars or have extra dollars. So the ability to manage rupee volatility is going to be much, much better than it was in the last 2 years or so. So I expect that if the oil prices remain high, rupee needs to fall, but RBI should be able to manage the volatility in a much better way. On the stock markets, Neil bhai, you know that 3 years back or 2 years back, our markets were like 2-3 standard deviations above their past ranges, meaning that the P multiples were excessively high, and they needed a period of time correction. Unfortunately, what happened, and I've been saying this for a while now, that in FY25, in this fiscal year 25, we ended up doing fiscal tightening and monetary tightening at the same time. So in any economy, when you have fiscal and monetary tightening happening at the same time, the economy decelerates. When the economy decelerates, everyone is disappointed. We saw the worst of our earnings cuts. While it does seem tragic that just about the time that the economy was starting to thrive, so as the fiscal tightening ended, the RBI also became conducive, basically supported, and the monetary tailwinds were starting to hit. Like March was a blockbuster month. You look at cement, cement was Jan-Feb was strong, March was a bit iffy. Auto sales, credit demand, amazing strength in the economy. So for now we take a breather because there is a terms of trade shock. But I think that once this uncertainty gets over, and it's a question of when, not if, because it is so painful for the world that it has to end. And therefore, whenever it ends, I think that the economic momentum will resume, and that will bring the excitement back to the stock market.